Mm-hmm. We're live, and I'm just, as we're going live, I can see I'm getting the ding-dings from Deribit here, so I'm getting some fills on some of the tomorrow expiries. All right, how's everyone doing? Oh, we got Ina, we got Luke, Giandrea. Always nice to have the Italians with us. Can everyone hear me okay? Make sure I'm not on mute. Richard, I assume you can hear me.
I can always hear you. Too much, if anything.
Too much, yeah. Bonjour, Tom, Sebastian, Vic, Jason, Isabella, Annette. Great. We got just tons. We got lots of new faces here, lots of the regular crew. Great to see you on this Thursday. Well, it's our Thursday afternoon. And so it's kind of like the post-market event, first one. So we've got lots of interesting things to talk about.
Or is it?
Well, maybe it's just a continuation. Dun, dun, dun. Tune in next week to find out, right? Yeah, cool. All good. I think things have been going pretty good. The P&L's been creeping up, which is nice to see. Steady Eddie, the volume, the IV has been holding steady. We had a bit of a spike after it was on the 17th when the market took a bit of a drop. Of course, we had a spike, but since then it's kind of steadied out, both Bitcoin and Ethereum. So that's good to see. Maybe we'll go sideways for a while, maybe creep back up. There's still lots of opportunities to sell volatility. We're still in the summer doldrums. So we'll see what happens. All right, let me just go through here and put up my poll. So, in light of what happened last week, which happens about every 3 months, so it's really nothing that special, the poll question is, do you regularly take action to defend or profit from significant market events? Because, of course, today's topic is about protecting yourself, right? It's becoming sort of bulletproof from any, multi-standard deviation market event. So I think that in general, most traders I've met over all those years never take any action, or if they do, it's kind of, it's in response to something happening. So we'll see what you guys have to say about that. Do you do it always? Do you do it occasionally, or rarely, or never? So that'll be interesting to see by the end of the show. We'll come back to that.
This is interesting. There's more people saying rarely or never than I thought. So just a little bit of stats. As Shane has alluded to, I've done some research into backtests of markets and looking at historical data from Deribit. And the long and short of it is that we see a 10% move in Bitcoin on average every 100 days or more. When it goes up, that's often over the course of a day. When it goes down, that's often in one candle.
one scary candle too, not a pleasant candle. That's, and we've been kind of going off that research you did where, let's just say approximately every 3 months we'll get a 10%-ish move,
or 10 or more,
or more. And I think that's nice, because if you're trading Microsoft and you're building protection for your Microsoft shares you own, or you just like to trade it, it's still a different asset. It's usually not going to move that much. I haven't been watching Microsoft in a few years, so I really couldn't honestly say that's true. I'm just pulling that asset out of a hat. But we know in crypto, we've got the volatility. We see that about every 3 months, something 10% or more happens. So why not prepare for it? There's no reason to think that's not going to change going forward. It's not like all of a sudden these regulations are put in place and everybody's happy and calm, and crypto's still going to be pretty volatile. So I think it's better to prepare. All right. So let's see here. Okay, great. Everybody can hear me. I know I already read that. Let's just go to the slides. I'm going to go to the next slide here. Today we're going to talk about how to become crash proof. There's lots of ways to do this. There's good ways, there's bad ways, there's expensive ways, there's cheap ways. So we're going to talk about those. It's something we always do. And in fact, I view market events, whether it's up or down, is an opportunity to significantly increase my portfolio. Now, Has it done the opposite to me? Yes, it has. It absolutely has, like any trader out there. But over time, I think it's a good idea to prepare and to always have that what if. It's the market, anything can happen, right? So this is what we want to talk about today. And I think that we're going to present a lot of solutions for people, no matter what kind of trader you are. If you're very active, if you only check in once a week, there's something for everyone in here to at least allow you to mitigate the damage, if not take advantage of it. Because it's nice to have 2 or 3 times a year, boom, a nice little bump up to your P&L in addition to whatever else you're doing, just because of an event that you were prepared for, or at least not get hammered on it, or only lose a smaller percentage, right? So hindsight is wonderful in trading, as is in most things in life. All right. Here, hang on. Let me just make my make our screen a little smaller here, Richard, just so that people can see the words a bit better. Okay, so guys, basically preparing for this sizable or some type of multi-standard deviation event is something that very true traders do. Now we're looking at our poll, and it's proving me correct. And if they do, what usually happens, it's kind of like, oh my gosh, it's haphazard, or it's a knee-jerk reaction. It's very sporadic, right? And it might give you some amount of coverage, and that's better than nothing. It's better than nothing. But probably because most retail traders look at the cost of doing it, they're like, oh man, I don't know, it's kind of expensive, I don't have enough margin, or this is money I could be using somewhere else, especially if you do it for months and months and months and nothing happens, right? You think it's money wasted. It's like having to buy house insurance, and then after a year going, oh man, a stupid house didn't burn down. What a waste of money that was, right? So
you're kind of reminding me of my single anecdote from when I first started trading, which is that 18-month streak I had of selling vol on the FTSE 100 and always winning every month for 18 months straight. And I started off, of course, by buying protection, selling iron condors, and then by the end of the 18 months was selling naked strangles, borrowing money at 0% to leverage up on selling strangles in a leverage fashion. So leverage on leverage, and as you can imagine, it was amazing until while it lasted, and then of course it all ends badly. I think I took a £250,000 hit on in one day from all that. And it's funny because you get used to the dopamine, particularly if you're selling vol and vol's dropping, and in crypto that can happen for over the summer. It happened for 3 months straight. You get that constant dopamine drip, and you don't want to feel the discomfort of giving money away. And but you have to take your medicine, and you've got to buy your insurance, because otherwise you're going to get it all taken away in one day.
Yep. True words never spoken, because it always happens. And when things change, it's not like you get this warning. The market's starting to do something that lets you know that, oh, you better buy some coverage. No, it'll just change. You'll wake up next morning and it's a different reality, and you're in trouble. So let's not do that. So, hey, there's a lot of strategies out there. I mean, we're not going to cover them all. We're just sort of talking about the things that we generally do, from different accounts, different assets, different market conditions, okay? Whether it's up or down, all right? Because some people will, even though if you're trading on Deribit and you have the underlying asset, it's good if it goes up. You can still get hammered if things go up, if you've sold a ton of calls and you're underwater, right? So both up and down. So you can do this instantly, or you can do it over time. And the difference is that a period of time before full protection is in place and the cost of doing so. So some only want to have a little bit of a hedge. There's nothing wrong with that. It's okay. Just have a bit of a buffer there. Others want to be fully hedged or over hedged. And if you're over hedged, you're going to get paid if it moves one way or another. So our general methodology, I'd say our preferred methodology, is to build in the protection over a bit of time and get paid. Now that might take you a month to do or 3 months to do. It depends on what you're doing. But yeah, if we can get paid to do it when we can, or have it for free, wonderful. Because free insurance is always the best insurance. So immediately, what can you do? If you're scared, if you sat down to your computer and said, oh my gosh, I'm so scared, the price of Bitcoin is going to go to 20,000. Well, buy some puts. It's just that simple. You can buy calls or puts for whatever direction you think it's going to go. Again, for most people, it's often sort of a knee-jerk reaction. It's the market's already moving and they're scrambling to buy some puts. And of course, the price is going to be through the roof. Your account's probably already getting hammered. It's expensive. Even if you do it when nothing's happening, which is better because it's going to cost you less, it's still going to cost you money, right? So it's an expensive way to go. But there's nothing wrong with doing that. Short-term protection, it's a good one. It's not going to cost you so much. Gives you some peace of mind. Okay, fine.
Again, it's the hardest thing in the world to buy puts when the market's going up, and it's the hardest thing in the world to buy calls when the market's going down.
Yeah.
But particularly in crypto, you'll hear people talking about skew a lot. So when the market starts to drop, you'll see all the option surfaces repriced and all the prices skewed towards puts. So puts get expensive. So they not only get more expensive because the market's going down, they also get more expensive because volatility is rising, because general fear is rising, and they're getting more expensive because the vol surfaces are being skewed towards the puts because more people are buying puts than buying calls, and market makers have to offload their risk somewhere, get rid of the inventory somehow. So they put their prices up to persuade people like me to come in and
Sell them.
Yeah. So having discipline and not trying to think too much about it is probably the best way, because it takes the emotion out of this. Never be afraid of buying puts when the market's going up, vice versa.
Yeah. And, and just instead of just buying the put outright, well, you can always do it as a debit spread. It's still going to cost you a bit of money, but it's going to cost you less. You're just going to put a cap on the amount of profit you can make. You're reducing the cost of it. There's nothing wrong. I do debit spreads all the time. They're wonderful in certain situations. Now, you can make it free and have it pay you by turning into a ratio spread. So you're selling two against every one, and you're going to be left with something that you might have to manage in the future, but that's an option. Okay. That gives you your free insurance. You don't have to do it every time. You can do it as a one-time thing. You can do it as a diagonal, which talk about. So this is only going to make sense at certain times. And maybe when technical indicators line up, you have to feel comfortable doing it at that time. If you sell a ratio, you have to feel comfortable with it. If the market's screaming down, I'm less inclined to sell a ratio on that side, but I think I'm going to be put in the money on those shorts. I'd rather wait till there's a nice technical reason for me to sell more puts than I'm buying.
There's kind of a opportunistic way to look at this too. So at the moment, for example, the market's got at the money vols of about 38, 37, but it's got about 13% smile. So the 10 delta fly, so the 10 delta calls and puts are on average 13 vols higher than the at the monies. So the smile's quite steep. So that makes things like 1x3s quite attractive, because you tend to get a lot of value on the lower delta leg. So if you're buying close to the money and selling 3 of the far from the monies, you can often get a profit from that and get a nice safe setup.
Yes, and this is something we talk about on our Telegram channel all the time. And in fact, I think last Monday you were saying we had about a 20 vol.
There was in December, yeah.
Yeah.
No, that's right. Next March. It's March. It's for the
leap or
halving.
Yeah. Which is extraordinary. So sometimes you'll see situations like that where you can take advantage of. But so if you do have the last point here, if you do have a naked option purchased, there can be opportunities to sell against them in the future. So let's say you're scared of a market going down and you buy some puts. Well, as the market moves around, you might have an opportunity to sell puts against it to reduce, turn it into a spread with, to reduce the cost. So there's always that opportunity. If you buy some puts and the market goes straight up, you're probably not going to get an opportunity to sell puts against it. But hey, it's insurance. You just got to view it as insurance. Immediate insurance. So there's a host of other strategies that can be used. We can talk about putting on directional butterflies. There's all kinds of things we can do that are lower cost alternatives to just buying naked. Okay. But the point is, it's easy to put on immediate insurance. It's immediate. It's usually going to cost you something. And most traders, when they do it, are responding to something. So they're kind of freaked out, or they're all scared. They feel forced to do it. They might be in the wrong mindset, and you're probably going to be paying elevated premiums when you do so. So, if you want some insurance immediately, do it when nothing's happening. You're going to pay less, right? Or when things are going the opposite way, which I'll talk about in a second. Now, we can take a strategic, a little bit more longer-term approach to this, and it's going to be more cost-effective. It's going to ensure sort of a continuity of coverage because you're going to be smeared and spread out over different strikes and over different expiries. And you can adjust this according to your bias. If 1 month you're getting a bit more freaked out, well, you put a little bit more allocation towards that, fine. It also ends up being cheap or free. It requires less maintenance because it's more of a systematic thing. Okay. And what some people can do, or what anyone can do, is if they want, they can take a percentage each month. Let's say you make X amount per month. You can take 10%, for example, put it aside and say, hey, every month I'm going to buy some out of the money options as protection. Okay, fine. Every week, maybe you're buying a 10 delta or a 5 delta or something, who knows, 30 days expiration, 60 days, 2 weeks, whatever you want to do. If you systematically do that, you're going to end up with this smear of different strikes as the price moves around and different expiry dates. You're going to have that coverage. Now, these are deep out of the money options, right? So most of them aren't going to pay off. It is nice though, because what you're doing is you're chipping away lightly each week. Okay, so you're not spending a lot of money, but after a period of time, you're going to have really nice coverage. You're going to have really complete coverage. In the event that the market does make some, goes 25% in 3 days, well, you're going to pay it, or at least you're going to be protected from it. All right. Now, as some of these out of the money options become near or in the money, they're going to become a little bit more valuable intrinsically and in usefulness. Okay. So again, we can sell options against them when there's opportunities to do so to generate some income. So I always keep that in mind. If ever I'm buying low delta options, so it's always in my mind that, hey, those are there. I expect them to expire worthlessly and not make me a cent, but most of the time we can do something with them to at least reduce the cost of them. Okay.
It's also worth mentioning that when you're buying low delta puts, for example, you're not betting that those puts are ever going to be in the money necessarily. Yeah. What those puts are is actually a Vega play. And there's a bit of gamma involved, but not much because the delta's low. So let's say, I don't know, today you bought 1 month 18,000 Bitcoin puts. They're currently 3 delta, according to the derivative screen on net delta 3. I don't think there's any way on this earth that Bitcoin's going to be down to 18,000 in a month, but it could be down 20%, for example, if something horrible happens. And if it's down 20% from here, then it's down to 20,000, which means it's dropped about 6,000, which means that those 18,000 puts are now going to be 20 delta. And even if they didn't go up if the vols didn't rise, they're going to increase in price by about 7 times. But of course, vol, if you get a 20% sell-off, vol's going to double. So actually now that they're 14 times what you bought them for, even though they're still out of the money. So if you're just chucking away, as Shane says, 10% of your winnings, almost like thinking about tithing in church, right? You 10% of your earnings you just give to the gods in case they come and decide to bend you over something and do nasty stuff to you. You just keep them happy, right? Just make the sacrifice, because one day you'll be glad you did.
Yeah, I think we should start our own trading church. And maybe people can pay us 10% each month, and we'll do special rituals to them.
We'll bend them over, and yeah.
I was thinking we just pray to the gods for them, but that's okay. So look, ultimately each year we can offset some of the costs of these other money options. Like, yes, sometimes they're going to be valuable. We can sell them for money, but worst case scenario, we can at least offset some of that cost to reduce the cost of the insurance. Okay. And this is really important because according to the testing we've done, if you're buying these deep out of the money naked calls and puts, you're going to lose money in Bitcoin and Ethereum on balance, just like you're going to lose money if you buy insurance. Okay. So if you expect these things to pay you off big all the time, it's not going to happen, but it's nice to have there because you do get these big events. It's nice to have. So in my mind, or in our mind, earning premium against these things is part and parcel. It just makes sense. So it makes a big difference. So besides selling options against the long-term options systematically, where we're talking every month, you're buying 5 deltas or 10 deltas, whatever you happen to do, we can increase the odds of profit by buying options when they happen to be cheap. Like Richard said, if the market's screaming up, it's hard to buy puts, but that's when you should be buying puts because they're dirt cheap. They're on fire sale. Buy them when they're cheap. Okay. Buy the out of the money calls when the market's going down, because we see the market go down. We see it retrace, or 3 weeks later, we're right back to where we were. I mean, how many times have we seen that? All the time, right? So it seems like a dumb idea at the beginning, but
and it's just like taking your daily medicine. You just hold your nose and do it. You don't think about it. Don't think about the cost. Don't worry about the loss.
There you go.
Because one day it'll yes, it's going to cost you 10% of your profits for 9 months out of 10. Actually, in crypto, more like 2 months out of 3. And then one time in 10, it's going to save you. Yeah.
So looking for the lowest IV on the volatility surface is another thing you can look, or the lowest time decay. That all I'm trying to say here is just look for the best prices. Okay.
Have a look on the what do I call it in Deribit? The options data with the little 9 dots, the left-hand corner. Have a look at the smiles and see which one. Look at them in terms of IV, in terms of delta, and see which ones where the skew is. At the moment, the skew is towards the calls.
Yeah.
So calls are a bit more expensive. Actually, so right now, puts are a bit cheaper.
I was just going to say, Richard, maybe if you want to share that later at the end, that would be probably useful for people to see those smalls. Yeah. Another consideration, and it's a little bit less palatable to the average trader, but it's statistically more successful. Instead of buying these cheap out-of-the-money options, well, buy less at-the-money options. It scares people because of the cost. They're like, oh my God, it's so expensive. Well, you know what? You're almost guaranteed. If I buy an at-the-money call or a put, I know I'm going to be able to sell calls and puts against them at some point in the future during their life and reduce the cost. And I can buy fewer positions for a greater impact. All right. So, or you can do a blend of both. Buy a little bit of some deep out of the money, buy a little bit of some at the money, and spread it around. I mean, that's probably the smartest way to go forward.
If you're a natural option seller, as we are, there's absolutely nothing wrong with owning like a 6 month or 1 year straddle. And just forget about it. Just keep, and it almost serves the same function or similar function to paying your 10% to buy your out of the money teenies, but slightly different because you don't get quite the same effective gamma, but it's a great Vega play and great delta hedge, gamma hedge rather, and you won't notice the decay. One Bitcoin option decaying over a year is going to be like $3 a day. Who cares?
Yep. Yeah. Great. Good point. One other thing to do, and I do them all the time, and I love them. Diagonals. We've already discussed them, so I won't go into it. But you're buying the long-term option. You're going to pay for it by selling shorter term, which have that faster theta decay. Sometimes you're going to have to roll them. That's life. If I buy some March or some June 2024s, I'm expecting some of those weeks. I usually sell the weekly against it. Some of those weeks I'm going to have to roll it. Whatever. That's fine. That's life. That's trading. More often than not, those diagonals are going to be fully paid for well before their expiry. Okay. And it ends up becoming free coverage. And when the timing is right, sometimes I'll sell those shorter term weeklies at a much higher ratio, 2-to-1, 3-to-1, and pay for it even faster. We've talked about diagonals before. Now, we can also look at the Johnny on the spot approach, is do nothing, just forget everything, and just layer on some stop market orders, okay? Some future orders on top and bottom. I do this all the time. I do it. I can look at my screen. I see it looks like someone went crazy with a spirograph on it because I do that. Now, if the market breaks, I'm on board. I'm guaranteed. It's harder to do that with options because the market drives up. Big market event, everybody disappears. You got to remember the deltas of those positions are going to change rapidly. So if I've got, I'm buying, 0.1 of a Bitcoin or something, that might not do too much of a hedge when the market moves fast because those deltas are going to really change. You can get caught in head fakes and wicks. So you need to be around to manage those and adjust them. The danger here, though, is if you get a big market gap, where's your fill price going to be? It might not be such a pleasant price, right? So relying on this as the only thing is something I would not do. But I think it's a great hybrid to use with other techniques. You're using some small future orders, stop market orders, staggered out on each side of the market to assist what you're doing. I think it's wonderful. And of course, these can be adjusted anytime, depending upon your bias. You can do an immediate partial hedge. And this is something we love to do. If you're just sitting every now and you're not doing anything, which is there's no problem with that type of trading, because you can sit and wait for everybody to start screaming their heads off, then get in, and you're in a much better position. But every time you take a position, you just put on a little tiny hedge. If I take on or sell one Bitcoin, that's my delta's minus one Bitcoin. Well, I could just buy, 0.1 of a Bitcoin future. It's not going to save me, during a big market event, but it's going to take some of that pain off, and it will gain in value if the market moves against your primary position. So go ahead.
We did a talk on this where I confused everyone. I think it was on our first Deribit talk about how the delta of a position decays over time because of the effects of the smile on the vol surface, and we should do an in-depth tutorial on that at some point. But if you're, for example, selling calls, there's a good reason to underhedge your futures. So if you sold one Bitcoin of 10 delta calls, you'd naturally think to hedge that you would need to buy 0.1 of a future. 10%, but actually the delta on your calls will naturally decay each day as your calls get lower and lower delta, because they as they get closer to expiry, they get further up the smile, and further they get relatively less moneyness, if you could think of it that way. And so actually your hedge needs to reduce each day as the delta of the position reduces. So selling calls and slightly under hedging with long futures is a reasonably good strategy. And similarly, if you're selling puts, slightly under hedging with a short future also works well.
Mm-hmm. Yeah, no, and I think we do need to go a little bit deeper into that in the future for sure. Gosh, we're almost out of time. I'm going to ask permission if we can go a bit over time, so we can both get into our positions and a little bit of our strategy here. And we'll have time for a few questions. So Bitcoin, I've got nothing going on right now, but that's going to change very soon. I'll have some positions there. Let me go to ETH, and I've cleaned up my charts because it started to look like chaos. If you remember, I've had this diagonal on, right? So I bought these 27 October 1800 puts. I sold some August 25th 1750 puts against them 1-to-1. Now, during this big market event over here, what happened was I just came on and I decided, hey, this might be the real thing. Maybe we're going to go down, to 1400. I don't know, right? Who knows? So I decided to roll it to a strangle. But it took half the number of the contracts down and out to September 29th, 1600 puts, and I doubled the number of contracts onto the 1900 calls, because calls are easier to manage than puts, and I got a nice juicy net credit for those, and that was quite nice. So I'm sitting in that position.
Shane, I've lost your sound. Does everybody else hear me? Shane, do you want to disconnect and reconnect? It's only your microphone I've lost. Obviously, you can hear me. In the meantime, I have not a clue how to interpret Shane's charts, so I'll move on to some of my positions that I'm on. Yeah, he'll come back in a second. Let me just. It's like one of those everything will be okay on the night TV shows, isn't it? Where they do the outtakes from TV shows. So you'll see here, I've got on 1st of September, so that's about a week away. Yeah, just over 7 days. Don't worry about this wall of the short calls I've got here, just for the moment. These three puts actually came from a 1x5 put spread that's expiring tomorrow, which I rolled. So the way this position started was I bought the 28,000 put. Can you believe it? And I sold 5 times as many 26,000 puts on the 25th of August. So when of course we had the 10 or more % drop down to 26k, I think we got to 26k ish at some stage. I was $2,000 in the money on my 28,000 puts, and I was at the money on my 5 times 26,000 short puts. So what I did was actually bought back so I sold the long that's in the money, and then rolled the 5 for the 5 times. It was actually 1 Bitcoin of short 26,000s, and I rolled it out to 1st of September at these strikes. 24,500, 24 and 23.5. This is what I call smearing. I like to, if I'm going to increase the risk, I like to put it on more than one strike, so I can deal with it piecemeal if I need to. And when I sold this 24,500, it was actually for about 80 basis points, so it's about double what it is now. So within a week, I was able to pull in all the cost of the losses on the short put, and actually more than cover that, because I received more premium for rolling it. Plus, I received all the profit from the long leg at 28,000. So actually, that entire position became profitable. I think I might have also smeared a couple. Yeah, I smeared a 3 out here for 2 weeks in 23,000 and so on. I took the view that I wanted to take advantage of that roll, because actually I was quite comfortable that the market probably wasn't going to drop below 26,000. But I didn't want to just risk it all on a hunch. So I thought, well, let's just buy myself another, I don't know, $3,000 of space, and I'm continually delta hedging anyway. So I was quite happy just to convert. And actually, what you find is then the at the money's vol would have been about 40 at the time, but the smile vol was more like 50 or 55 at the time. So actually, I'm buying 40 vol at the money to sell 50-55 vol, 20-10 delta, that kind of range. So even though I'm trading down, I'm writing a bit more risk, but I'm actually getting much better value. So I've converted. So what that trade did was allow me to position myself for a rise in vol without having to actually spend any money, if that makes sense. Anyway, Shane's back.
Can you hear me though?
Yeah, I can hear you.
Okay. Sorry, I have no idea what happened. I'll just quickly share my screen because I know we've run out of time here, basically. So we'll whip through. Again, at this diagonals, you can see I bought the 1,800 puts, sold 1,750 puts. So I'm selling the weeklies against those monthlies. Okay. I've actually, so I got a nice credit for that. During this crash down here, I decided to put on a diagonal up because the calls were cheap. So I bought 27th of October. So the monthly October and the December 1,800 calls. I sold the 1,750 calls again, them 1-to-1. Now I kind of fully expected to have to manage those because I wouldn't have been shocked at all if the market had bounced right back up to where it was or close to. But so far I haven't had to deal with those, and those are decaying very nicely. I did put on another diagonal because I love to have the extra protection on down. I love making money when the market goes down. Now, these were on August 20. I put on these December 19th, about the 1,600 puts, and I sold the August 25th against them. Only 1-for-1. I'm not.
I lost you again, Shane. Actually, while Shane fixes that, I will answer the question actually from computer. The margin's pretty high, isn't it? You're right. I think it's worth highlighting this because here I'm using 68.77% of maintenance margin and 82.52 of what do they call it? Initial margin. And obviously, my advice to you is don't do this. Actually, on this account, I normally run the maintenance margin at about 50% and the initial margin at about 60, which is also way too high. But it's worth me mentioning that this account has an automated delta hedger behind it, and so what looks like huge margin does get squashed, or the deltas do get squashed actually every hour. So I'm not running that much risk hour to hour. And also, this account is designed for accumulating dollars, not accumulating Bitcoin. And as you can see here, I'm running a short perpetuals position to essentially turn all of my underlying margin into synthetic dollars. By the way, that at the moment that's making about 8% a year in compound interest, and that actually that conversion to synthetic dollars costs me about 15-20% in margin use anyway. So actually, it's not as bad as it looks. But it's definitely on the high side, and actually, all of the risk is coming. The margin engine does what the margin engine doesn't like is these overnight positions I've got expiring on Friday, tomorrow. So these positions were written over the course of a week, and they're all gradually just expiring. And in fact, I did prune some of these off. There were a whole load more, all at close to zero value, and the margin bill did get up to about 80%. Maintenance margin, so I did some pruning just to get rid of those. Even though normally I just leave them to expire because that costs me a bit less in trading fees. But there's a kind of a trade-off, right, between putting on more risk to earn more money and resenting paying the trading fees. But also I've got a couple of positions here for 2-day and a couple of positions on the 3-day, and these positions tend to be quite expensive on margin because the margin engine assumes a 15% shock to spot, and a 15% shock would actually cause these positions to be in some pain. So I run these positions really small, and I just write a little. I just write a between 10 and 20 delta 3-day call every day, just as a little experiment to see what that makes me. So that, but if I took those off, well, I wouldn't lose much in terms of earnings, but it would use a lot less margin. Okay.
I don't know if you can hear me now. I had ditched the headphone. I think it was a headphone problem, so I ditched those. But anyways, I guess I don't think we need to go back to the chart. I've got my diagonals on. I've actually just covered the weekly, the September 25th expiry. I just covered those, and I've just sold the September 1st. Those are 1600s against the long 1629 December as part of the diagonal. So that's lovely. And I did put on a debit spread too, just a plain old debit spread. I meant to do it as a ratio, but I just didn't get the fills. But I was long the 1750 puts, short the 1650s. So we're sort of almost at the max profit area there, and I'll be looking to take that off here pretty quick. I would have actually done it the other day, but I was away and just missed it. Whatever. But that's it. So it's all going pretty good. After the quote unquote crash, we've just kind of stabilized a bit now. We have had a few wicks. Will we stick to the pattern of crypto making a big move and then going sideways for a while? Maybe. I don't know. But I would expect to move because we're coming out of the summer doldrums. We've got things going on as we get into September. I don't think it's going to stick here for too long. Maybe a couple weeks maximum.
Shall we just skim through questions? We're already...
Yeah, and I don't see the questions because I logged out and back in.
Okay.
So you'll have to go through them. Sorry.
Okay, I'll go through them in reverse order. So from computer, your margin's pretty high, isn't it? Yep, covered that. From Gian Andrea, no audio from Shane. Okay, you're back. From Jean Ewani, do you make some scalps from 0-day data expiry during market events? I don't. Do you, Shane?
Do I make money from 0 DTA events?
Do you scalp them?
Yes. If I'm not too busy managing other stuff, absolutely, I love it.
Yeah. And then from Luke, I'm confused. When you have a spread, your max profit is limited. Can you ever win more by playing the vol game? Well, whenever you're playing with options, you're playing the vol game. If you're selling options, you're selling vol, and if you're buying options, you're buying vol. So, yes, you're the thing about this is just to try to be quick about it. It's wrong to think of each options position being its own discrete trade, because each options position is actually a setup or a supporting trade for every other options position in your book and all the ones to come. So, for example, a classic trade that we like is in the right markets is selling an iron condor. So you sell a call spread and a put spread, same expiry. If the market rises and you're not feeling uncomfortable, you can buy your put spread back. So effectively, what you've really just done is bought a put spread or debit spread, as Shane calls it. And if the market drops again, you can resell that put spread. So you've actually been in and out then of that side of the condor twice. So even though your iron condor had a maximum payoff of say $3,000, you can actually find that you've now increased that to $4,000 by going into the put side twice. And of course, if the market continues to go down, you can leg out and back into the call side. And something I used to do on the FTSE 100 was I would sell a three-month iron condor, and I'd be in and out of one or other of the legs maybe, I don't know, 3 or 4 times during its lifetime. So yes, you are making limited amounts of money, but you've got an unlimited number of goes to do that, which is why it's really important not to be greedy. You're not trying to be in the market to make a one-off, 1 in a million trade because they are 1 in a million. What you want to do is chip away and take money when it's in your interest and when the dice favor you. From Jason, is there a difference in the risk-reward ratio being crypto and stocks, trading credit spreads? The risk-reward ratio seems very high on crypto. Well, it depends. You need to choose your strikes according to the market that you're trading. And crypto markets, vol is priced according to the way it moves. So if I were trading, for example, iron condors on crypto, I would probably be selling the spreads a lot further from the money than I would on, say, the S&P 500. That's just me. Unless I was expecting to sort of cross in and out through my spreads a few times, or I was prepared to delta hedge aggressively. So what I find works for me in crypto is playing the vol surface, actually trading, selling expensive parts of the vol surface and buying cheap parts of it. So actually trying to keep a balanced book, but actually essentially on the basis that in the end everything mean reverts. I'm trying to pick up relative value off the surface, but there's a whole bunch of stuff. But yeah, but also crypto definitely favors scalping for credit spreads and debit spreads because you can be in and out quickly and make money quicker than you might on the stock market.
We've only got a couple of minutes left, Richard.
Sure.
Unfortunately. Yeah.
Shall I just do one last question then? Luke asks, could you refer any good auto hedger that will work with Deribit? There is one, a free one, isn't there? That somebody in our Rogue Traders channel mentioned.
I don't recall the name of it.
Name of it, I forget. I'm actually also looking at the legals of us providing one. I use an automated auto hedger in my.
I lost your sound, Richard.
Huh.
What's going on? I thought it was my headphones, but
am I back?
I don't know. Okay. Well, we're almost out of time, anyways. I don't know if Richard's going to come back. Maybe it's a software thing. Maybe it's a problem with the software. So I'll answer one more question. Dennis was directed to me. Shane, why didn't you wait until expiry to tomorrow? I imagine there is a big spread for the short option gamma risk. Well, I'm removing the gamma risk. So I assume you're talking about the diagonal where I bought back the August 25 puts. All I'm doing, Dennis, I don't like to overcomplicate things like Richard does. Love you. I sell high and I buy low, or I buy low and I sell high. I mean, that's all he's doing too, but he's just a little bit more mathematical about it. I see an opportunity. I put in a bid practically next to zero. If I get filled, I remove the risk. I'm perfectly happy and I sell the next one. Do I want to let it go to expiry tomorrow? I mean, if I missed it, I did fine. I'd rather take that risk off the table because there is gamma risk there. Okay, we've gone. We're allowed to go 15 minutes past. Sorry about the audio problems. It must be a feature with this webinar jam with the software, so I'll have to deal with support after the call. But thanks everyone for joining us. Again, you can check out our offer. We got 7 days free trial. Hang out with us on our Telegram channel. We answer questions in there. We're there all day long. We're not going to chat all day long because we have regular work to do. But we do answer questions there, and we post all our trades in real time and commentary. So all good stuff. Please feel free to join us. Check it out. We will see you next week, and let's see what the market brings over this week. We're actually very excited to see this post-crash, what happens and how long it goes sideways. So thanks, everyone, for joining us, and we'll catch you next week.
Thank you.